Chapter 6 Financial Service Providers. This is the first of three chapters related to banking. So it's an introduction chapter looking at the different financial service providers, what a current account is, what kind of transactions you can make, and the types of providers there are out there. So a financial service provider, if you think about some examples, will be banks, commercial banks, credit unions, post offices. In particular, they now offer current accounts. Same with credit unions. So they're becoming a lot more like commercial banks. They're all offering similar services. So a financial service provider is an organization that offers money-related services. So whether it's for savings, a service for, as I said, current accounts, everyday transactions, they allow for that. Now, like any business, they do charge, so they're in it to make a profit also. So the main financial service providers in Ireland, as I said, are commercial banks. Some examples of that would be AIB, Bank of Ireland, Permanent TSB, Ulster Bank. So there's a few there in the market. The two main ones, AIB and Bank of Ireland, are backed by the government. So they're the two main pillar banks, as we call them. So credit unions, if you think about your local credit union in Kilkenny, for instance, or one, you might have a branch in your town. And then on post, as I said, post offices are offering a lot more of those services as well, their own current accounts. So commercial banks, they're also known as financial institutions. So are post offices, remember, and credit unions. So just think of the three when you ever hear about financial institutions. So as I said, some examples will be AIB or Allied Irish Bank, Ulster Bank, some other ones there, KBC and Permanent TSB, Bank of Ireland, Barclays Bank. A lot of these are English banks with branches here. Okay, so moving on then. Commercial banks, as I said, these offer a lot of services, financial services. So if you have a current account, you can do a lot of everyday transactions. You can transfer money, as it says here, you can do, and we'll talk about this more, standing orders, direct debits. You can have a credit card or a debit card, overdraft facilities, loan facilities, and then a separate type of account is a deposit account or a savings account. Okay, or you can make an investment, again, to earn dividends or money on or extra percentage on your money. And we'll talk more about savings and investments later on. Foreign currency exchange. So if you're going abroad to another country that doesn't have the euro, you can exchange for the dollar or the sterling there. Online banking. So you might be aware some of your parents use online banking. It's very easy now with technology and apps and on the phone to be able to, a lot of the time you don't even need to go into a bank. You can just transfer from one bank account to the other. So current accounts. As I said, it's an everyday transaction type of account. You don't pay interest because it's not a loan account as such. Now, if you do have an overdraft facility, we'll talk about interest having to be paid on that. So it's allowing to withdraw money, lodge money, and do everyday sending money to pay bills or pay rent, and whatever, mortgages, any kind of monthly repayments. So current account, as I said, you'll have a debit card. I'm sure you've all seen one now at this stage. So every bank will have their own one. So you'll have a debit card, so Visa debit, but you can also have a Visa credit. The debit cards are the ones where you have your money in the account, so it's your money you're using. You might see your parents tapping them at the till or going to the ATM, automated teller machine to withdraw money, or you might have to use a card reader at home and transfer money and be able to get some kind of security code from that. So anyway, so your Visa debit, as I said, is money you have. Visa credit, money you don't have as such. You have to pay it back, seem like a loan, but there's very high interest on it. So a check, it's another way of sending money. It's given instructions to the bank, so whatever details are on the check to pay a certain person named on the check, a certain amount. So it's written in words and in numbers. There's a date, signature. All of the codes are there for the bank, sort codes and account numbers, and then you'll have a stub here. That would be left on your checkbook, like this here, be torn off and the check would be handed over and the stub would be left and you keep your details there. So every bank would have their own one. They all look a bit different, but do the same thing. So checks are very safe. I suppose you're not sending physical money. So say if you wanted to send something in the post, a check would be the best option. Now, if you don't have a checkbook, you can get a bank draft. So it's similar, but it's the bank's check as such. So transactions that can be made in current accounts are standing orders, or SO for short. Think about something that's fixed. It stays the same all the time. It's standing, it doesn't move. What it is an instruction to the bank to pay a fixed amount of money at a regular intervals, maybe once a month, to pay for maybe rent or a mortgage or a loan repayment. Maybe you're paying off in a car or some kind of subscription. It's a fixed standing order, same amount every month. So fixed. Keywords there. Direct debit, on the other hand, or DD for short. Again, it's an agreement between the bank and the account holder. So remember I said when you're defining, always talk about who you're talking about. So who, the bank, the account holder. What are you talking about? So it's an agreement. What does it do? It allows variable amounts. So variable just means it changes. It's not going to be the same every month. So bills, think about telephone bills or electricity bills. All of these will change or vary. Okay, so what happens is that company, so Eircom or Air, they will go in and say electricity, if you have an account with them, if you owe them €100 at the end of the month, they'll go in and take the money out of your account. So it'll change, okay? But it'll be in around the same time every month as well. So here's an example of a bank statement. So you can see some of those transactions there. You will see, on a bank statement, you'll have all the details of the person, the branch, the bank branch, balance amounts and account numbers and sort codes, IBAN, BIC. You'll hear all these. This is more of an international within European Union, just to identify banks and accounts. So on your bank statement, if you want to have a look at your parents, if they'll let you, it's your dates, and you'll have the transactions, so standing orders. So maybe for a loan, you can see it's paid out 100 every month, and then that will reduce the balance from 350 down to 250. If you withdraw money from an ATM, for instance, again, it's money going out. Okay, so it's on the credit side. Whereas here, if you get money, so maybe you earn interest or maybe you get your salary paid in, so that's on the debit and that'll increase the balance. All right, so you can see there are examples of standing orders and direct debits. Here's for the fitness gym, so some subscription that they have there, and a debit card transaction there, buying something in a store, gas company, okay, and so on. So these are all probably credit transfers and transfer there from joint account. Maybe if they're partners having separate accounts, maybe use a joint account for paying bills. Okay, so we're going to finish up soon, but just quickly talk about other elements of a current account for this lesson. So you have your bank draft, as I said. If you don't have your own checkbook, the bank will give you it's like a check, really. It's verified by the bank, so you can send it in the post. An overdraft, think about it as similar to a loan, but you have to pay it back straight away. So you have an agreed limit with the bank in your current account. So if a bill comes out and you don't have money in it, the overdraft facility will cover that until money comes into your bank account. So maybe you have an agreement with the bank. Now, if you go over and you don't pay back, there is interest owed on that. Borrowing then, other ones, I suppose, other than an overdraft facility, you could, as I said, have a credit card, loans, mortgages. So it's borrowing from your banks or any financial institution. Okay, so credit cards, there's plenty of them out there, Visas, MasterCards, all right, but remember, it's not free money. It'll have to be paid back with interest. Okay, and your overdraft, again, is permission to withdraw money from your current account, and interest will be charged on that. So you might have an agreed limit of 500 maybe to use with the bank's money as such, and then once you get paid, it'll just clear all that. Okay, and loan then to finish up. As we know, it's a sum of money borrowed from a financial institution. So what are you talking about? Who are you talking about? What's happening? It's going to be paid back with interest over a period of time. Mortgage is a loan. It's secured against property. So you have to have something of value if you don't pay back the loan, that they'll repossess a house, apartment, for instance. Okay, so the next lesson we'll be looking at currency exchange. So what I wanted to do is in the book, at the end of the chapter, take down some of the definitions and do the first 3 questions, please. Thank you.